Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you're really well. I hope you've had a great couple of weeks. I'm sorry I wasn't around. Last week I was having a few days away in Istanbul, which was an incredible experience actually. I really enjoyed going there and experiencing all that Istanbul has to offer. I hope you guys are doing really well, and for those of you who are still on half term, which I know probably feels like it's been going on forever, I hope it's going well for you. It's nice that today, which is Tuesday, we actually have some dry weather. Now, in terms of what we've got for you this week, we're going to do our usual roundup of what those lenders have been up to in terms of interest rate changes and also criteria moves as well. We're then going to be talking about the latest predictions on inflation, what we're expecting to see inflation numbers coming at when the data is released in November, and also then show how we think that's going to impact interest rates over the next 12 months. And then we're going to talk a bit about house prices, so where they are currently and the predictions for what's going to happen there as well over the next 12 months or so. And then finally, we're going to be wrapping up with our new and latest feature, question of the week. Okay, so first up, lender changes, and also more broadly where we are with interest rates. So what I'm not going to do is run through 2 weeks worth of lender pricing changes because, well, that'd be really boring, wouldn't it? But suffice to say, there have been lots of changes over the last fortnight, and they've all been in a downward fashion, which is really positive. So let's just take a step back and look at where we are with swap rates at the moment. So 2-year swap rates today, 4.866. 1 month ago, they were 5.122. So they have come down month on month. 1 year ago, they were at 4.458. And don't forget, a year ago, we were just kind of recoiling from the aftermath of the mini budget nightmare. And so 2-year swap rates, even taking that into account, were lower than they were today. So not great year on year, but actually we have seen a distinct downward step month on month, which is fantastic. Same kind of story actually on 5-year rates as well. So 5-year swaps stay at 4.427, so we're under the 4.5 mark, and consistently so actually now, which is fantastic. 1 month ago, they were sitting at 4.611, and a year ago, 4.194. So things are going in the right direction, but it's very gradual, very slow. Now, in terms of lender pricing, so the more notable kind of reductions we've seen in the last few days, we've seen Keystone knock circa 15 basis points off their 2-year fixed rates. We've seen MT Finance drop their rates down. Virgin have dropped their pricing by 0.5%. And the Mortgage Works, which actually got quite a lot of publicity, is one of the largest buy-to-let lenders in the UK, it would do. They've dropped their rates down by up to 0.5% as well. So all looking like things are going in the right direction in terms of pricing. But like I say, no hallelujah moments, unfortunately. It's all just kind of small chipping away at pricing. Now, I thought it'd be useful just to do a bit of a roundup in terms of where rates are sitting across the board for you. So if you are looking at a vanilla deal, so a person landlord rather than a limited company landlord, refinancing or buying a property on a 2-year fixed rate, and the property would be standards. This isn't your HMOs and multi-units, these are kind of simple properties. 2-year fixed rate pricing from 3.8% with a 5% fee, or 5.24% with a flat fee of 3,995. 5-year fixed rates currently from 4.69% but with a 7% fee, ouch, or 4.69% with a flat fee of 3,995. Moving that on to limited company, more specialist lending. So limited companies, HMOs and multi-units, and those are those landlords with, generally speaking, more than 10 buy-to-let properties. This next bit is for you. So 2-year fixed rates from 4.49 with a 7% fee again, or 5.19 with a flat fee of 5,999. 5-year fixed rates from 4.69 with a 7% fee, or 5.79 with a 1,995 fee. Now, I'm trying to cast my mind back to where those numbers were sitting last time I went through this exercise with you, and actually things have definitely come down. So I think really, like I say, and I can't really reiterate this enough, it's going to be very slow, very gradual repricing, but still very much a downward step week by week from all of the lenders. Now, a real quickie in terms of lender criteria changes. We've had just one in the last 2 weeks, and that's Virgin. So what they have done is they've introduced a portfolio rental calculation on remortgages for those people with 4 or more buy-to-let mortgages in the background. So what they used to do is, if you were doing a remortgage on a like-for-like basis, so you weren't actually raising any additional funds, they wouldn't ask any questions about the background portfolio, they weren't stress testing it. But they've actually just now introduced stress testing if you're remortgaging on a like-for-like basis. So the rental cover now needs to be 125%, assuming an interest rate of 5% on the background portfolio. this is very, very standard practice actually. So most lenders will always do a rental calculation on the background portfolio, even if it is a like-for-like remortgage. So I think actually what Virgin have probably done is realise that they're a bit of an outlier in terms of their requirements, or absence of requirement actually, for a rental calculation on the background portfolio. So they've simply introduced it to bring themselves in line with the rest of the market. Now, in terms of inflation and what we're expecting to see with the latest data, or the new data that comes out in November, and I know this feels quite a long way away, but I think actually at the moment, any good news is very, very welcome. So I wanted to share a report that I've seen from a firm in the city, where they put out their predictions for inflation. So they are expecting inflation to fall really, really sharply actually when the report comes out for October, with the report coming out in November. And they're saying that actually inflation could be as low as 4.6%. Now, actually, even if they are kind of slightly optimistic and it is sitting at anything really below 5%, and that would be an absolutely incredible drop down from the previous 6.7%. But broadly speaking, we are very much expecting inflation to have come down significantly when the data comes out in November to cover off October. Now, the other thing just to say is in terms of how this is going to kind of impact things longer term in terms of interest rates. So I think it's kind of fairly common consensus that nobody's expecting a base rate increase again this week. And actually, looking at the way that the experts are expecting inflation to behave going forwards, and including the downward step for November's data, we are expecting inflation to come down quite rapidly going forward now. So in terms of base rate predictions, currently the experts are saying we could see our first base rate reduction as early as May or June in 2024. So actually only sort of like 7 or 8 months away now, which is fantastic. And there is an expectation we're going to finish 2024 with a base rate at 4.5%. So really, really good news. I mean, it obviously is really good news, but actually what it does do is throw people who are in need of a mortgage right now into a bit of a quandary in terms of whether to go for a tracker rate or a 2-year fixed rate, or a 5-year fixed rate, which is probably cheaper than the 2-year fixed rate right now, but in the round it could cost them more money. So it does kind of make those decisions actually quite difficult at the moment. In terms of what our clients are doing, and I think there's no kind of set answer in terms of what's right and what is wrong. Only ever is hindsight going to be the thing that gives you the benefit of what was the correct option to do, which would have saved you the most money. But in terms of our clients, we are definitely seeing an uptick in the number of people who are looking at variable rate products at the moment. It's not standard variable rates, because these are at 8, 9, 10, even in some cases 12%, but people looking to take variable rate products. And the other thing we're definitely seeing is a bigger increase in the number of people looking for 2-year fixed rates. Now, don't forget, guys, that shorter term fixed rates and variable rate products come with these slightly more onerous rental calculations. Some people simply can't have those. But for those people who are fortunate enough to be able to take their pick from a range of mortgage products, these guys are certainly really seriously considering variable rate products and also 2-year fixes. Now, HomeTrack have released their latest house price data, and I think just really the headlines are just worth sharing with you as a kind of good wrap up of where things are currently. So first of all, they said that house prices of inflation, has slowed from 9.6% to 1.1% over the last year. 4 in 5 housing markets are registering small annual house price falls. Now, that was a much smaller number even 6 months ago. So really what kind of started as the biggest problem as being in the southeast and London is kind of really starting to ripple out across the rest of the UK now as well, unfortunately. They say that regulation of mortgage lending has built market resilience to higher mortgage rates, although household buying power remains lower. Now, this is kind of quite key. So one of the things that is really limiting house transactions is the fact that when particularly homeowners, but also landlords, as we know from the rental calculations, because of the higher interest rates, the kind of stress test that's used in terms of affordability has become more onerous. So actually, when buyers are looking at how much they can afford to borrow on a mortgage, the numbers now are lower than they would have been, say, 18 months ago. So that's really kind of hindering the market there. They say that transactions will be hit the hardest and will be 23% lower than 2022. So transactions are 23% lower in 2023 than in 2022. First-time buyers and cash buyers account for 2 in 3 sales in 2023. Now, that's really interesting. So actually 1 in 3 purchase transactions at the moment are from cash buyers. So, you know, amazing that those guys are able to do that. And I suspect actually if you haven't got to rely on a mortgage with the higher borrowing costs and also the affordability tests, if you are going as a cash buyer, I imagine that really puts you in a position to be able to negotiate fairly aggressively in terms of the price that you can pay for a property. Okay, now here's the kind of bit you guys probably want to know. They expect UK house prices to fall 2% over 2024 as rising income steadily repair housing affordability. So we are expecting house prices to continue to drop throughout 2024 by just 2%. So essentially the rate of decline is going to slow right down because people's incomes are increasing, mortgage interest rates are going to reduce, and so actually affordability will start to kind of correct itself. And this means that actually the housing market will kind of bottom out, plateau, and then start to repair itself in 2025. Now, we had a meeting amongst all of our mortgage brokers, and there's about 20 of us actually at Mortgages for Business. And we had a really good discussion about where things are as a landlord, and, you know, would landlords be investing at the moment? And it is a kind of tricky situation, but if you just look at the kind of bare facts, so of course we have higher mortgage borrowing costs than we did 18 months ago. But actually in terms of pricing compared to a year ago, actually things are pretty much where they are. However, house prices are circa 5% lower, and it depends region, it can be higher in some cases, than they were a year ago, and rental yields have actually increased. So actually, if you are in a position of thinking about buying but aren't so sure, if you kind of take those key facts into account, so yes, interest rates are expensive, but they're lower than they were almost a year ago or a year and a half ago, house prices are significantly lower, and rental income has increased. Actually, you know, the market is more favourable to you than it was 18 months ago, and actually will continue to become, over the next 12 months, even more amenable to being a favourable investment market. So I hope that kind of gives any of you who are scratching your head wondering what you're going to do in terms of your investment strategy when you're thinking about next year, that actually maybe next year could actually be the perfect year to be investing in buy-to-let. Okay, now moving on to question of the week. So this week I was asked a really good question, which was that I am a full-time landlord. All of my income is derived from rental income. Can I still get a mortgage? Now this is a really interesting one because the requirements to be able to access a buy-to-let mortgage in terms of your own income does vary quite significantly from lender to lender. So I think first of all, let's make a distinction here. There are essentially two types of lenders. Lenders who say that they want you to be earning at least £25,000 to be able to access a mortgage of any amount with them. It's an arbitrary figure. I don't ask me why it's 25,000. It just is. It's been like that since I started working here 16 years ago. An arbitrary figure, but £25,000 a year. So lots of lenders will say we need you to be earning £25,000 a year. But there is another massive contingent of lenders who say we don't mind how much you earn as long as you're earning something. So there has to be a form of income of some way, shape or form, but we don't mind how much that is. And more lenders have kind of swung in that direction over the last few years. So in terms of rental income, so moving on to that now. So in terms of acceptable income, so lenders do, broadly speaking, in the buy-to-let market, accept rental income as income, essentially. So if you're a full-time landlord and you're netting after all your costs £30,000 a year, then there are lots of lenders who will simply say, yeah, we need you to earn £25,000 a year, and you fit that box, no problem. There are some lenders who actually won't lend to landlords where the only type of income they have is rental income. They will need you to have something else, so PAYE income from a separate business that you might run, or other kinds of income sources from your sole trader business. It could be investment income, it could be pension, it could even be something like spousal maintenance, but they do just need you to have an income from a separate source. So I think in terms of answering the question succinctly, if you are a landlord who has full-time income only from renting out properties, don't worry. Not every lender will lend to you, but there's no one individual who every lender would lend to. So it's not a massive disadvantage, but there are still going to be lots and lots of lenders who will be able to take you on as a mortgage borrower. And that is us done for this week. Thank you, as always, for taking the time to watch this. I really sincerely hope you found it useful. And if you have any questions, you know you can always give us a call, 0345 345 6788, or you can have a nosy at our website, which has got oodles and oodles of information on there as well. If you have got a question that you think would be interesting, either for your own kind of benefit, or also actually just a question that you think other landlords might be interested in, if you could just please pop it in the comments box below, so we can use it for our question of the week, it'd be really appreciated. It'd be good to kind of get some real kind of dialogue going in terms of, you know, kind of things that have maybe entered your head occasionally. You've just wondered, well, why is that the case, or, you know, whatever it is. So please do leave your comments. But for now, enjoy the rest of your week, have a super weekend, and I shall see you again same time next week.